From smartphones to gaming consoles to tech-dependent cars, there's a massive supply crunch facing some of these everyday devices. It's because of a shortage of the semiconductors, which are at the heart of all electronic systems.
Demand actually increased across all the electronics segments. There is a greater demand for electronics in a car. So the confluence of all these factors with increased chip demand, and I would say because the foundries and the integrated device manufacturers were unprepared for this huge sharp increase in demand towards the end of the last year, that resulted into a demand-supply mismatches and resulted into a chip shortage.
The chip shortage could potentially mean that the cost of electronic gadgets could shoot up.
For example, graphic cards are currently sold at a retail price of about a 50 to 100% markup to what the manufacturer's recommended sale price is. And usually the markup is less than 30%. And of course, for graphic cards, there's a secondary demand driver, which is cryptocurrencies. With regards to other products, we are expecting a kind of consumer price stickiness. So for example, the PlayStations and Xbox, they have always been selling for about 500 USD, and we don't think there's going to be a big price change here.
For now, analysts say that the supply crunch is good news for chip stocks, as earnings are likely to get a boost amid increased demand.
The rise in share prices, I think it is still sustainable at this point in time. And the reason is because earnings for semiconductor companies, they have been growing across the year thanks to the increasing demand. And on top of that, the companies themselves, as well as the analysts, they are also predicting that earnings for 2021 and 2022 will continue to grow, which would lend some support to share prices.
Shares of TSMC, for example, the world's largest contract chip manufacturer, with clients including Apple, have gone up by over 11% this year alone. Meantime, Intel shares have soared over 30% this year after the chip giant said that it was launching its own foundry business.
Outlook for companies like TSMC and Samsung should remain positive in the future, mainly because they are the world's leading chip makers in terms of technology. So with that kind of technology, many companies would naturally flock to them to manufacture their chips. On top of that, these two companies, they have also announced massive capex to expand capacity in the future, which is an indication that they remain positive on the demand for semiconductors going forward.
Analysts say that the overall expansion in semiconductor capacity could bode well for semiconductor-linked companies in Singapore.
This shortage scenario actually supports the current semiconductor equipment upswing. So for AEM, 2021 could be a cyclically soft year because of the high base from 2020. And of course, that being said, we do see upside drivers, first of all, from potentially accretive M&A. We think that this year, AEM is going to really tap into their balance sheet strength and acquire companies so that they can be even more competitive when it comes to system level test. And I think Intel's capex direction as well, we believe that that should also filter through positively to AEM.
Franken is one of the most diversified semiconductor related companies on the SGX. It's favored by the market because it's one of the few companies that gives forward guidance as well, which makes it less uncertain for the investors. And last year, despite the pandemic, the semiconductor related revenues grew about 60% year on year. And in the first half of this year, it's expected to grow again. So we are seeing growth on growth for Franken. Additionally, Franken trades at fairly attractive valuations of about 11 to 13 times forward price to earnings. So UMSH, which counts Applied Materials as a key customer, we are still positive on them because Applied Materials has recently given financial guidance up to 2024, and they are expecting to grow about 50% in the next 5 years. So this is a pretty good medium-term runway for UMSH. Additionally, UMSH has recently cut their dividend in anticipations of a potential new customer win. We see this as a catalyst for the share price to reach a new high.
However, once the chip crisis resolves, possibly towards the end of this year or in 2022, experts warn of a short-term correction in the share prices of some of these chip plays.
As share prices go higher, the possibility of them coming down increases. But at the same time, I think the pandemic has caused a huge shift from offline to online. And with many companies going on the path of digitalization, we think that the demand for electronics will continue to remain robust. And that should lend support to the earnings as well as the share prices of these semiconductor companies.
At the end of the cycle, all things equal, just focusing on this implies lower year-on-year earnings potential, and as a result of that, we would typically see funds rotate out from these sectors and move on to other sectors. Just focusing on within the Singapore tech space, potentially then what could happen is that the interest could shift from the semiconductor equipment supply chain into the contract manufacturers. The peak is always very difficult to call. We still have to be very disciplined in tracking chip makers' spending plans, as well as the pace of also how the various supply chains rebuild their inventories.